What is up, Strategic Freedom? Coach DC here. I have a quick video I want to go over with you. Maybe not quick, maybe like 8, 9 minutes, but I want to go over with you the top 3 tax strategies your CPA isn't using. Now, it's December in 2025. You may not be able to implement all of these, but you can do at least one of them. All right. So it's December 5th today, 2025. So if you are in a pinch and you're staring down the barrel of a high tax bill, for 2025, I'm going to give you 3 things, one of which I know for a fact you can use very quickly here. 2 of which could be a little bit tough, but pay attention, lean in, all right, and we're going to cover some things here. Again, I'm Coach DC, Strategic Freedom Consulting. We help our clients protect, preserve, and prosper their wealth. And so again, what I'm going to share with you real quick here is the top 3 tax strategies that if your CPA isn't using, you want to get on top of immediately, okay? Again, late in the year, but let's go. Number 1 is a cost segregation study. If you bought some real estate this year, okay, you know, or maybe you don't know this, but in January of 2025, when President Trump took over, they reinstated 100% bonus depreciation on real estate in the One Big Beautiful Bill. So what this means, again, if you just look at what I have here, you can do what's called a cost segregation study, okay? And what that can have major tax savings. It can have big implications for you. But what it is it's an engineering study that reclassifies parts of your property. So when you buy a property, let's say it's $500,000. Let's say the building itself is valued at $300,000 and the land is valued at $200,000. All right, most of you know you can't depreciate the land. So right off the bat, you can't touch the land. So that $200,000 you can't depreciate. However, you can depreciate the building and its contents, meaning flooring, furniture, like all these different things, roof, all these different things can be depreciated because they have a lifespan. Previously, it had to be broken up over like 27 and a half years for residential. For commercial, it was 39 years. What we're looking at now, this bonus depreciation, you can actually speed that up and depreciate a large chunk in year 1. So again, what this looks like, we have an example of one of our clients. They bought a $500,000 rental property. Normal depreciation, again, without this bonus depreciation, would have given them maybe $18,000 a year in deductions. After a cost segregation study was performed, he accelerated $150,000 in depreciation to year 1, wiping out his entire tax bill. Again, you can see this is the language after the One Big Beautiful Bill Act 2025. Section 168K allows real estate investors to deduct 100% of the cost of qualified tangible property in the year it's placed in service instead of depreciating it over time. Again, this does require some skill. Could require an engineer, certainly a CPA that knows their stuff. Again, it's going to depend on the property that you purchase, the age of it, all of the above. But again, you can accelerate a large chunk of depreciation. Big time. I mean, you could have savings on this. Like many people are going to save $100,000 in taxes using this one strategy. Okay, so that's number 1. Again, another scenario. Again, real estate. Before I move on, residential real estate, commercial real estate, business owners that own their building, or you bought a building for your business. These are all new. These are all applicable here. And you can see this quote here. This is not new. It's just that when they reestablished it, it's now allowing anyone with a property over about $400,000 can accelerate $100,000 to $200,000 in deductions. Okay. So that's number 1 tax strategy for this year. Number 2, the Augusta rule, Section 280G. I've been deploying this for a number of years now. I hadn't used it for a number of years because I wasn't aware of it. But again, it's been huge help for me and my tax planning and many of our clients. Now, again, when you understand this, the reason it's called the Augusta rule is because of Augusta, Georgia, is where they host the Masters golf tournament, correct? So every April, there's Augusta hosts the Masters tournament. And local people that live in that area started renting their houses out short term because they were getting really high dollar per night averages because there was this major demand in Augusta, Georgia for people to stay. Okay, so now it's become that people rent out their personal residence for just that week and they make a good amount of money. So again, what this means in the IRS language, you can rent your home to your business for up to 14 days per year. And that is tax-free. Rental income is 100% tax-free. It's a business deduction. Again, so this is my personal example. I've been doing this for the last 2 years. I had done it previously, but these numbers are accurate in the last 2 years because I had recently moved my primary residence. So again, I'm the wealth strategist here at Strategic Freedom. And again, what I'll do is I'll host a client retreat. I could host employees at my house. I've also used my house as a recording studio. I'm actually recording right now at my house. And again, what we're looking at here is on average, I'll charge my business $2,000 per day. Now, again, I use a comparable Airbnb rate. So again, if you look at like a comparable property in your area, that's where I'm basing my rate off of that. So now I'm generating $2,000 a day times 14 days per calendar year, and I'll generate $28,000 in tax-free income annually. Now, what this means is if I'm saving $28,000 a year, because I'm moving that from my business to my personal, that means that in an average 35% tax bracket, I'm saving $9,800 a year in taxes I otherwise would have given to the IRS. Again, so I'm saving almost $10,000 by renting my home to my business for business purposes. Again, some examples of this: you could host quarterly team meetings. I've done that. We can run client workshops. I've done that. Annual planning sessions. And the key is if you do these during high demand periods, like if you live on the coast and let's say the summertime, your area is in high demand because people want to be near the coast. Again, you want to do these things strategically during that time so you can charge top dollar for your per night average. All right. Again, you're going to document all this and you're going to need to have comparable rates. But again, once you do this legwork one time, it's very easy to rinse and repeat year after year. Okay. And then number 3, this is one of my favorites. I've been using this strategy for years. I mean, probably 15 years I'm going on using this strategy to pay your children for legitimate work. Now, again, this has major potential savings. Okay, I'm going to give you a couple scenarios here. Basically, your kids do real work for your business. I've used social media work, filing, folders, bookkeeping. You can use modeling. Again, if your kids are quite young, let's say you have a 1 or 2-year-old, they're obviously not going to do legitimate work for you, but could they be part of your marketing efforts? Could you put them on a brochure? Like if you own an HVAC company, could you have a picture of a baby sleeping comfortably? And that is part of your marketing material because you have a great controlled temperature environment. So again, there's different ways that you can do this. And again, what we can do is in 2025, we can pay them up to $14,500 a piece. All right, completely tax-free. No payroll tax, no Medicare, none of that stuff. You're going to be able to pay them up to $14,500 a year tax-free. All right, so why does this work? Your business gets a tax deduction, right? And again, assuming you're at a 35% tax rate, and depending on how many kids you have, again, I'll use the example myself. I pay 3 kids $14,000 each, okay? And that saves me $14,700 annually in taxes. Again, 3 kids at $14,000 each is $42,000. I move, again, from my business, I pay my children. And then based on a 35% tax bracket, again, I'll save $14,700 annually in taxes I otherwise would have given to the government. All right. So again, they must do actual work. We must keep, good records here, and then a reasonable rate for the work performed. It's been in the tax code for a very long time, so there's nothing gray about this. If your CPA pushes back on cost segregation, paying your kids, Section 280G, the Augusta rule, then your CPA is working for the IRS. They're not working for you, okay? So again, what this means, quick math here. If we did a cost seg study, all right, and, again, I had given a different scenario before, but if I've had clients save $100,000 using a cost seg study. If you have, depending on how many kids you have or how much you're running your house for me, my goal is to save $100,000 or more every year using these 3 tax strategies. Okay. So $100,000 I would have otherwise owed in taxes. Now, again, I'm only talking federal here because state taxes, some of these things don't apply, and state taxes can be tough and vary, obviously, but like I'm talking federal. But my goal is $100,000 a year that I'm going to save using these tax strategies. And then I can redeploy that money. Again, it's essentially found money because I'm using some different strategies. Now I can take that $100,000 and I can invest it in things like Bitcoin, more real estate. I can invest it in the stock market. I could buy gold and silver. there's a number of things you can do, and whatever, aligns with your investment philosophy, you can utilize that. But again, our goal, this is really like, we want to protect our assets, which we talk about. Then we want to preserve our assets. Tax strategy is preserving your assets, because otherwise you would have given that money over, and this is all 100% legal. Then the big thing, prosper. We're now going to take this newfound money, we're going to put it to work for us so that it creates more money for our future. One thing I'm going to tell you, with tax savings money, do not buy lifestyle things. Do not buy a new car. Don't buy a vacation home. Don't do things that are not going to create more wealth for you in the future, because again, you're going to not want to take this money. You want this money to create the future for you. All right. You don't want to spend it now and not have that upside. All right. So I really hope you saw some value in this video. Again, Coach DC, Strategic Freedom Consulting. We help you protect, preserve, and prosper your wealth. This is to 2026 being the best year you've ever had in your business. Make sure you like and subscribe. Reach out to us. We'd be glad to set up a call just to see if there's something we could do for you. If we think we can help, then obviously we would love to work with you and create more just, abundance in your life. And that's what we're looking to accomplish here. So great seeing you. We'll see you in the next video.